Hello and welcome to the Investing Views. In this video, we're going to learn about common stock and its working dynamics. So what exactly is common stock? At a basic level, common stock represents equity ownership in a corporation, most commonly in publicly traded companies. Holders or investors of common stock have the right to vote via voting shares and elect a board of directors to vote on corporate policies. They are also commonly referred to as equity shares, and they grant stockholders the right to share in the company profits and have a say in corporate policy. Owners of common stock don't own any particular assets in the company since they belong to all the shareholders in common. As a shareholder, it's important to be aware of the 6 major rights legally extended to you. The first is voting power. Voting power includes electing directors and proposals for fundamental changes affecting the company, such as mergers or liquidations. The second is ownership in a portion of the company. Common shareholders have a claim on a portion of the assets owned by the company. As these assets generate profits, and as the profits are reinvested into additional assets, shareholders see a return as the value of their shares increases and as the stock price goes up. The third right as a shareholder is the right to transfer ownership. The right to transfer ownership means that as a shareholder, you're allowed to trade your stock on the exchange. This is very important because it provides liquidity to the general stock market. It permits you as a shareholder to buy and sell shares in a stock. The fourth is the right to participate in corporate dividends. Investors also receive a small claim to any profits in the company in the form of a dividend. Depending on your investment style, being able to participate in dividends can play an important role in your investment philosophy. The fifth is the right to inspect corporate documents. Shareholders have the right to examine basic documents such as company bylaws and minutes of board meetings. In addition to this, as a public shareholder, you have the right to review financial performance of a company through their 10-K filings. Publicly traded companies have to file quarterly financial reports and follow the rules set by the Securities and Exchange Commission. The sixth and final right is the right to sue for wrongful acts. This typically happens through some sort of shareholder class action lawsuit and gives shareholders the right to pursue legal action if a company is found to engage in fraud or financial mishandling. In addition to these 6 rights, it's important to note that shareholders have the right to directly request a company's financial records, the list of other major shareholders, and other records that they legitimately need in order to fulfill their ownership duties. It's also important to note that in the event of a liquidation, common shareholders have the rights to a company's assets only after bondholders, preferred shareholders, and other debt holders are paid in full. Next, we will take a look at how the common stock formula works, along with some examples and calculations to help you understand it better. Common stock is reported in the shareholders' equity section of a company's balance sheet. And there are essentially 2 different ways to calculate common stock, and it depends on whether or not there are preferred shares involved. With preferred shares, the common stock formula equals total equity minus preferred stock minus additional paid-in capital minus retained earnings plus treasury stock. Without preferred shares, common stock is simply total equity minus retained earnings. This calculation method tends to be most common with smaller scale companies that have less complex financial structures. As an investor, it's important to be aware of the differences between common stock and preferred stock. So how does common stock differ from preferred stock? As we already know, common stock is the most widely available type of shares issued by a company and what you will likely encounter when trading stocks through your broker. As previously mentioned, these shares typically come with voting rights, but are last in line of being repaid if a company happens to go bankrupt. On the other hand, preferred stock, or commonly referred to as preferred shares, have priority over common stock when it comes to dividends, which are generally yield higher returns than common stock and are paid either monthly or quarterly. Preferred shareholders have limited rights, which usually does not include voting rights. While preferred stock and common stock are both considered equity instruments, they do share some important distinctions that investors should be conscious of. Preferred shares receive a fixed dividend, as dividend obligations to preferred shareholders must be satisfied first. Preferred stock does not have the same fluctuations in the price of the stock to the degree that common stock can have. This is a major difference that can make preferred stock a more stable investment compared to common stock. Common stockholders, on the other hand, may not always receive a dividend, and that dividend can be subject to change anytime the company sees fit. Common stock can also carry a higher level of volatility and risk, as well as higher potential returns for investors. In essence, preferred stock tends to work more like a bond rather than common stock does, and carries a redemption value, much like a bond at maturity does. An important distinction to make when trading common stock versus preferred stock through a broker is that common stock will have a different ticker symbol compared to preferred stock. Preferred shares will usually be denoted with the main ticker name followed by a dash and a letter abbreviation. The letter abbreviation constitutes the different series of preferred shares. It's worth noting that not all brokers will offer preferred shares for trading, as the management of this type of product is much more complex than common shares. In order to understand common stock better as an investor, it's important to take a step back and look at its originating roots. Let's take a brief 1-minute history of the establishment of common stock to gain some further perspective. The first ever common stock was established in 1602 by the Dutch East India Company and introduced on the Amsterdam Stock Exchange. Over the next 400 plus years, the stock markets have farmed all over the world, with tens of thousands of companies listed on global exchanges like the London Stock Exchange, the U.S. Stock Exchange, Tokyo Exchange, and many others. Larger U.S. stocks are traded on public exchanges, such as the New York Exchange or the NASDAQ. There are also several international exchanges for foreign stocks. Companies that are smaller in size and unable to meet an exchange's listing requirements are considered unlisted or referred to as pink sheet stocks. These unlisted stocks are said to be traded over the counter. Now, before we wrap things up, there's some additional considerations regarding common stock that are important to know that can help further enhance your knowledge, specifically around the area of risk, IPOs, and proxy voting. As previously mentioned, with common stock, if a company goes bankrupt, common shareholders do not receive their money until creditors, bondholders, and preferred shareholders have received their respective shares. This makes common stock slightly riskier than debt or preferred shares. However, the upside to common shares is that they usually outperform bonds and preferred shares in the long run. Large publicly traded companies issue all three types of securities. For example, Wells Fargo & Company has several bonds available for trading on the secondary market. In the event of an IPO, common stock is very important. For a company to issue stock, it must begin by having an IPO. An IPO is a great way for a company to seek additional capital and expand its operations. To begin the IPO process, a company must work with an underwriting investment banking firm that helps to determine both the type and the pricing of the stock. After the IPO phase is completed, the general public can buy and sell common stock through exchanges in secondary markets. This is the main process through which company stock is issued and made available for trading to the general public. Lastly, it's important to understand the relationship between common stock and proxy voting. Most ordinary common shares come with one vote per share, granting shareholders the right to vote on corporate actions, often conducted at a company's meeting of shareholders. If you can't attend a shareholder meeting, you can choose to cast your vote by proxy instead, whereby a third party will vote on your behalf, along with others who can't attend the meeting. Votes may be held on issues such as whether to merge with or acquire a company, elect a board of directors, approve stock splits, or make changes to dividends. We hope you've enjoyed this video and now have a better understanding of common stock. Let us know what topic you would like to learn about next, and make sure to smash that subscribe button.